Here's a number that should genuinely bother you. Banks in the United States have collected billions of dollars a year in overdraft fees, and a meaningful chunk of that revenue didn't come from people spending money they didn't have in some reckless, obvious way. It came from a specific, well-documented practice called transaction reordering. And once you understand how it actually works, you'll never look at your bank account the same way again. Here's the trick, stated plainly, because it's not a conspiracy theory. It was the subject of real lawsuits and real regulatory settlements against several major banks. When multiple transactions hit your account on the same day, banks don't always process them in the order you actually made them. For years, many banks process transactions from the highest dollar amount to the lowest, rather than in the chronological order they occurred. That single sequencing choice sounds like a minor technical detail. It isn't. It's the difference between one overdraft fee and 5.
Today, I want to walk you through exactly how this mechanism works, why it stayed legal for so long, and what actually changed. Because even now, with more protections in place, the underlying incentive hasn't fully gone away. Let's walk through the actual mechanism with real numbers, because this only makes sense once you see it laid out. Imagine you have $100 in your checking account. Over the course of one day, you make 4 small purchases: a coffee for $5, lunch for $12, gas for $18, and a grocery run for $20, followed by one larger transaction, a $150 rent payment that clears the same day. In the order you actually made these purchases, only the very last transaction, the rent payment, would overdraft your account, because the 4 small purchases together only total $55, leaving plenty of room before the rent payment pushes you negative. That's one overdraft fee, typically around $35.
But if the bank processes that same batch of transactions from highest amount to lowest instead of in chronological order, the $150 rent payment gets processed first, immediately pushing your $100 balance negative. Every single transaction that follows, the coffee, the lunch, the gas, the groceries, now also overdrafts because the account is already negative before any of them process. Same 4 small purchases, same day, same starting balance. But now, instead of one $35 fee, you're looking at 5 separate overdraft fees, potentially $175 or more, generated purely by the order transactions were processed in, not by how much you actually spent or when you actually spent it. This wasn't an accident or a rare technical quirk. Internal bank documents that surfaced during litigation showed that some institutions were aware this reordering practice measurably increased overdraft fee revenue, and multiple major banks in the US paid hundreds of millions of dollars combined in legal settlements over exactly this practice throughout the 2010s. The practice wasn't hidden exactly. It was usually disclosed somewhere in account terms and conditions, but it was structured in a way that almost nobody actually reads or understands until they're staring at 5 overdraft fees on a single statement, wondering how a $100 account balance somehow generated $175 in fees from purchases that individually added up to far less than that. Here's why it stayed legal for so long, and why the story is more complicated than pure villainy. Banks are generally permitted to set their own transaction processing order, as long as it's disclosed in the account agreement customers sign when opening the account. Regulators eventually stepped in, and rule changes plus the settlements meant many banks moved to processing transactions in chronological order, or at least stopped defaulting to high-to-low ordering as an unstated practice. But, and this matters, the shift largely happened through settlements and voluntary policy changes, rather than an outright universal ban, which means the practice hasn't been eliminated everywhere, and newer or smaller institutions aren't automatically exempt from using similar reordering logic today. The incentive that created the practice in the first place, more overdrafts meaning more fee revenue, is still technically there. What changed most concretely is that customers now have clearer opt-in requirements around overdraft coverage itself, meaning many people can decline it altogether, rather than relying on the bank's processing order to protect them.
Let's talk about what this actually costs someone over a year, because the phrase draining your account needs real numbers behind it, or it's just a dramatic title. If someone experiences even one multi-transaction overdraft event, like the example we just walked through, 3 or 4 times a year, which is genuinely common for people living close to the edge of their balance, that's potentially $500 to $700 annually in fees that could have been a single fee, or in many cases, no fee at all, if the transactions had simply processed in the order they actually occurred. For someone already managing a tight budget, that's not a rounding error. That's often more money than they'd otherwise manage to save in months of careful, deliberate cutting back elsewhere. So here's what I actually want you to do with this information. Check your own bank's transaction processing policy. It's usually described somewhere in your account's terms and conditions, or you can simply call and ask directly how same-day transactions are ordered. Check whether you're opted into overdraft coverage at all, because in many cases now, you can decline it entirely, meaning a transaction that would overdraft your account simply gets declined instead of generating a fee. And if your bank's policies feel opaque or unfavorable compared to what's now standard at many other institutions, that's genuinely worth factoring into whether it's still the right place to keep your money.
This isn't about assuming every bank is actively working against you. It's about understanding that a specific, well-documented mechanism existed and generated real money from ordinary people's ordinary spending patterns. And in some form, parts of that underlying incentive structure still exist today. Knowing the mechanism is what lets you actually check whether it applies to you, instead of just vaguely feeling like your account drains faster than it should without ever being able to say exactly why. If this explains something that's happened to you before without you understanding why, hit that like button. Subscribe if you want more videos that dig into the actual mechanisms behind money instead of just repeating budgeting tips. And tell me in the comments, has this ever happened to you? And did you ever figure out why? I read every single one.